One of the best performing stocks in my personal portfolio is Broadcom, stock ticker AVGO, and it's now trading at $1,802.52 per share. And over the past year, it has more than doubled, up around 110%. And if we look at the past 5 years, it's now up nearly 600%. And in fact, if we jump over to my do-it-yourself investor toolkit and blow up my growth chart, you can see this is a position I'm now up over 253% on. So this has clearly been a massive gainer. Now, if we look at just the past few days for the stock, we can see the share price has jumped up quite a bit, up about 4.71%. Now, what was the catalyst behind this? Well, if we look at their recent earnings report, we can see a lot of good news. First off, Q2 non-GAAP earnings per share of $10.96 was a beat by around 12 cents. That is a decent beat. We can see revenue came in at $12.49 billion, which is a beat by about $480 million, but was also up 43.1% year over year. Obviously, this is great results, but there's even one more thing that has investors even more excited. If we scroll down here, we can see they announced a 10-for-1 stock split, and this is expected to take place on July 15th, 2024. So in this video, I want to briefly review Broadcom and what the 10-for-1 stock split means for this company. Now to start off, let's go ahead and jump over to my dividend breakdown sheet. Again, you can download any of my spreadsheets over on tickerdata.com and also get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. Now, if we come over here, let's go ahead and plug in AVGO and hit enter. And we can see all the data for this company will automatically load in. Now, over the past 2 or 3 years, I've been constantly talking about how Broadcom is one of my absolute favorite dividend growth stocks. And for the longest time, they actually had a higher starting dividend yield of around 3%, but at their current share price, it's sitting at about 1.17%. Now, if we jump over to Seeking Alpha, click on dividends and click on dividend yield, let's go ahead and scroll down. We can see again, over the past 5 years, there's been many time periods, as we can see up here, where the starting dividend yield is closer to around 3.5%. And in fact, October of 2022 is around when I first bought this stock. So I got a nice starting dividend yield of about 3.5%. But since then, the share price has been going up so much that that starting dividend yield has been going lower. But here's what else you have to understand about this company. Even if you didn't buy in at a nice starting dividend yield, the company is rapidly increasing their dividend payments, which will then eventually increase your dividend yield on cost. It's pretty amazing to see the dividend growth over time with this company. We can see in 2013, the company's paying out about 88 cents per share. But if we look at them in 2023, it jumped all the way up to $19.05. And as of right now, it's sitting at about $21 per share. So they have a 10-year compounded annual dividend growth rate of 32.81%. That is absolutely unbelievable dividend growth over the past decade and over the past 5 years, 13.4%. And like always, what makes this even more beautiful is this was completely backed by free cash flow growth. Look at the free cash flow growth down here. We can see in 2013, the company is generating around $486 million in free cash flow, and it's steadily climbed ever since then. And in 2023, it got all the way up to $17.6 billion. So again, the past decade has been an absolute tear for this company, and we can see the free cash flow payout ratio stayed in a pretty healthy range during this entire time, never going above 50%, and for the most part, the past few years, just a little bit above 40%. So again, most of the free cash flow can still be used to be reinvested back into the business or buy back shares or even pay down debt. And paying down debt is actually something this company has to constantly be doing. Let's talk about that. If we jump over to my balance sheet breakdown sheet, come up here, plug in AVGO and hit enter, and the data will automatically load in. Now, purely from a ratio perspective, if we look at the current ratio over time, again, this is total current assets divided by total current liabilities, and it gives us an idea of how easily the company can meet its current debt obligations. So we want to look for a current ratio of over 1, and it looks like AVGO is in a pretty healthy position. If we look at debt to assets ratio, it looks like it's pretty consistently been around that 50% range. Again, I think that's pretty healthy, but we have to keep in mind a lot of this company's growth is coming from strategic acquisitions. So let's go ahead and look at the raw data of total debt. If we go ahead and scroll down and zoom in, we're going to be able to get a better picture of this. We can see right here, total debt. In 2013 to 2014, it looks like total debt climbed by quite a bit. Usually when we see this with AVGO, it's because they performed an acquisition. And after they do that, they typically try to pay down debt, which we can see in 2015. Then it looks like they performed another acquisition and then they started paying down debt, another acquisition and started paying down debt. This is kind of a trend we see with the company. But the good news about this is this has not harmed their balance sheet because their total assets are climbing at the same rate. Again, because we can see that debt to assets ratio, this is just total debt divided by total assets. This hasn't been climbing much higher, especially over the past 4 to 5 years. This debt to assets ratio is in a healthy position. Now, if we take a closer look at the recent earnings report, we can see the two main business segments that the company operates in. We have semiconductor solutions, and then we have infrastructure software. Now, if we come over here and look at semiconductor solutions, we can see year over year, looks like they're seeing decent growth, and as of the most recent earnings report, they're up by about 5.8% year over year, and quarter over quarter down by about 2.5%. So overall, looks like it's decent growth. But when we look at the infrastructure software, this is where everything changes. Year over year, they're up 174.5%, and quarter over quarter, 15.6%. So that infrastructure software is where the vast majority of the company's growth is currently coming from. And so we can see overall adjusted EBITDA year over year up by about 30.6%. Now for a moment, let's talk about that stock split. Again, the company is having a 10-for-1 stock split that is expected to take place on July 15th. Now, how does this affect AVGO? Well, basically what it means, if you own 1 share of AVGO, all of a sudden, the stock will be split and you're going to own 10, but the share price will be divided by 10 as well. So with the share price currently at $1,802, that means the share price of the 10 stocks you would own would be about $180.25. Now, it's really important to remember this doesn't fundamentally change anything about the stock. In fact, if we jump over to the stock screener, we can see Broadcom, earnings per share, revenue per share, free cash flow per share. Nothing fundamentally changes about these metrics, but they will be divided by 10. So technically, a company announcing a stock split shouldn't really impact the decision you make as to whether buy or sell the stock, but the reality is, for a lot of retail investors, it does incentivize them to buy the stock. It begins to feel cheaper to them, and it also makes the stock more accessible to them. So typically, we do see shares go higher in the market when this is announced. Now, the last thing I want to touch on with Broadcom is simply the profitability of the company. If we look at revenue versus cost of revenue, what we can see, revenue has exploded like the other metrics over the past decade, but if we look at cost of revenue, it's been growing but not near the rate of the revenue growth. So what's the end result of this? Well, we can see really nice increases in the gross profit ratio over time. We can see gross profit ratio 2013 about 47.5%, and in 2023 it's sitting at about 68.93%. So when we consider the fact that 10-year revenue CAGR sitting at 30.4%, and during that same time period, we saw gross profit ratio increase by about 20%, you get explosive growth from the company. So overall, I'm obviously very excited to see this growth from Broadcom. This is a stock I've held in my portfolio for a while now. It's performed great from a dividend perspective and a growth perspective, and obviously a dividend growth perspective, and I plan on continuing to hold my shares as of right now. And I also think it'll be interesting to see how the market responds to the 10-for-1 stock split. So go ahead and let me know what you think of this company in the comments down below, or if you want me to dig into them just a little bit deeper. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.